Imagine trying to basically swap out the engine of a commercial jetliner while it's cruising at like 35,000 feet.
Right, and doing it without spilling anyone's drink.
Exactly, without spilling the drinks, without the passengers even knowing anything is happening. That level of, high stakes, hyper complex mechanical replacement, that is what we are looking at today. But in the realm of enterprise software.
Yeah, it's a crazy scenario.
It really is. We're looking at a company that basically ripped out its entire legacy architecture, rebuilt its central nervous system completely from scratch, and is now, performing that exact same invisible surgery on some of the largest hospitality brands on the planet.
And doing it while posting 17 consecutive quarters of record revenue. I mean, that is the part that defies the usual gravity of the software industry,
Yeah.
Usually when a company undergoes a massive structural rewrite like that, you see a huge dip in their financials.
Oh, for sure. The classic valley of death.
Exactly, the valley of death. R&D costs just spike, revenue stalls out because, sales team has nothing new to sell, right?
Right. Which actually brings us to the mission for today's deep dive. We are taking a magnifying glass to the Q4 and full fiscal year 2026 earnings call of Agilysys. That's ticker symbol AGYS.
A really fascinating call.
Definitely. If you hold this stock, or, if you are scanning the enterprise software landscape looking for a highly profitable, kind of under-the-radar player, we are breaking down this earnings report specifically for you.
And we're doing it talk ticker style.
Yes, exactly. We are bypassing the usual Wall Street jargon, ignoring the superficial headline reactions from financial media, and we're looking directly at the underlying mechanics. Our framework is simple. We're hitting 4 things. First, the headline numbers. Second, the story driving that data. Third, management guidance. And finally, the bottom line.
Right, whether this is fundamentally a bullish or bearish signal for you as a retail investor.
Exactly. So before we dissect the Q4 numbers, we really need to anchor ourselves in what Agilysys actually does.
Yeah, because they aren't exactly a household consumer name.
Not at all.
They are a pure play B2B hospitality software company. They are not, building apps for your smartphone. They build the mission-critical digital plumbing for massive hotels, sprawling luxury resorts, global casinos, and managed food service environments like, corporate campuses or university dining halls.
So we are talking about the underlying infrastructure. Like if I walk into a mega resort in Las Vegas, what exactly is running on Agilysys software?
Honestly, almost everything that involves a transaction, a reservation, or a piece of data.
Wow.
Yeah. They dominate in 2 primary categories. The first is property management systems, or PMS.
Which is like the brain of the hotel, right?
Exactly, the brain. It manages room inventory, housekeeping schedules, guest profiles. And then the second is point of sale systems, or POS, which handles every single food and beverage transaction.
But it goes beyond just those 2, doesn't it?
Oh, yeah. Their ecosystem extends into highly specialized modules. So they handle the spa reservations, the golf tee times, the digital kitchen routing screens, self-service kiosks in the lobby, and even the mobile check-in process on the guest's phone.
That's a massive footprint.
It really is. Basically, if money or data moves inside that physical property, an Agilysys module is likely capturing it, routing it, and analyzing it.
Okay, that sets the table perfectly. Now let's look at the financial architecture supporting that ecosystem, starting with part 1, the headline numbers.
Let's do it.
The sheer scale of the top-line data here requires serious attention. The revenue records are staggering. In Q4, they posted revenue of $82.9 million, which is an 11.7% increase year over year.
And, like we mentioned earlier, that makes it their 17th consecutive record revenue quarter.
Yeah, 17 in a row. I mean, a trend like that, especially through the macroeconomic volatility of the last 4 years.
The inflation spikes, the interest rate hikes.
Right, exactly. Shifting consumer travel habits. It suggests a product market fit that is almost totally insulated from broader economic headwinds.
What really speaks to the non-discretionary nature of their product. I mean, think about it. A consumer might decide to skip a vacation if the economy slows down, right? But a multi-billion-dollar hotel conglomerate cannot simply turn off its property management system.
The software literally is the business.
Exactly. If the PMS goes down, the hotel literally cannot issue key cards. They can't check guests into rooms. That mission-critical status provides, incredible revenue resilience.
And when you zoom out to the full fiscal year 2026, the absolute numbers actually accelerate. Full year revenue hit $319.3 million, up 15.9%.
Which means the growth rate is actually compounding on a larger base.
Yeah, but buried underneath that top-line number is a metric that management hammered on repeatedly throughout the call: subscription revenue.
The golden metric.
Yes. In Q4, subscription revenue was $36.9 million, growing at 24.1%. And for the full year, it was $137.1 million, growing at an astonishing 30.2%.
That is massive.
It is. I want to trace the mechanical difference between this and their legacy business model, because Wall Street clearly applies a huge valuation premium to this specific bucket of revenue.
It all comes down to the mechanics of compounding predictability versus the, constant treadmill of perpetual licenses. Let's look at the legacy model first.
Okay.
Historically, Agilysys would sell a perpetual software license to a hotel. The hotel would pay a massive upfront fee, say, $500,000, and they would own that version of software forever.
Sitting on a server in a closet somewhere.
Precisely. They would install it on physical servers sitting in the hotel basement.
Okay.
And Agilysys would get this huge, immediate spike in revenue for that quarter.
Right, but then the next quarter starts at zero.
Exactly. The sales team have to go hunt down another $500,000 deal just to maintain the exact same revenue run rate.
It sounds like a high-stress, highly variable way to run a business.
It creates incredibly lumpy earnings, and Wall Street hates that because analysts cannot reliably forecast the cash flows. But the SaaS model, software as a service, it completely inverts that dynamic.
Because it's cloud-based.
Right. Agilysys hosts the software in the cloud, likely on AWS or Azure. The hotel doesn't buy the software. They rent access to it. So instead of $500,000 up front, they might pay, say, $150,000 a year every year on an auto-renewing contract.
So wait, in year one, Agilysys actually makes less money on that specific customer.
They do, but by year 4, they break even. And from year 5 through year 15, it is pure, recurring, high-margin profit. The revenue layer cake just keeps stacking.
I see. So the $300K you signed 3 years ago is still paying out, plus the $300K you signed last year, plus the new deals you closed today.
You've just described the holy grail of enterprise valuation. When a company demonstrates that they can grow that subscription bucket at 30% annually, while maintaining high retention rates, the valuation multiple expands dramatically.
Because investors are no longer paying for a one-time transaction. They're buying an annuity stream.
Exactly.
Okay, let me test that logic against another number from the transcript, because there is a counter trend happening. Their product revenue, which comprises those old perpetual software licenses and third-party hardware reselling.
Right.
It was completely flat year over year, $41.2 million. Now, if I'm an investor looking at a high-growth tech company, seeing an entire segment of their business completely stalled out at 0% growth usually sets off alarm bells. Why shouldn't we view that as a failure to execute?
Because, actually, that 0% growth is the undeniable mathematical proof that their transition to the cloud is working. Yeah. Think about it. If that product revenue line was growing, it would mean Agilysys was still heavily reliant on selling clunky proprietary hardware endpoints to hotels. Specialized cash registers, massive server rack.
Dedicated on-premise terminals, yeah.
Exactly. The fact that the hardware and legacy product revenue is flat, while the overall revenue is surging, means the customer base is actively migrating away from the old physical infrastructure.
So they are essentially cannibalizing their own low-margin hardware business on purpose to force the transition to high-margin software.
That's exactly it.
I assume hotels are realizing they don't need to buy a $5,000 proprietary terminal from Agilysys when they can just buy a $500 consumer iPad and run the SaaS application on it.
That is the exact mechanism driving this. And management explicitly called this out on the call. The operators in the hospitality space are augmenting traditional hardware needs with consumer market available devices.
Right.
So when a resort buys an iPad from an electronics retailer, Agilysys records $0 in product revenue.
Okay.
But the moment that resort downloads the Agilysys point-of-sale app onto that iPad and logs in, Agilysys starts collecting a monthly subscription fee per device.
Okay, that mechanical shift explains the margin expansion perfectly. Because I was looking at their gross profit margins, and in Q4, their gross margin expanded to 64.4%. That's up almost 400 basis points from a year ago.
It's a massive leap.
Yeah, because if you are selling a physical cash register, your gross margin is terrible. You have to manufacture the plastic, assemble the silicon, ship it across the ocean on a cargo ship, store it in a warehouse,
And then physically mail it to the hotel.
Right.
The cost of goods sold on hardware just eats up a massive portion of the revenue. But when you shift to cloud-based software, the cost of goods sold is practically zero after the initial development.
Delivering the code to the 1,000th customer costs the exact same as delivering it to the first customer.
Virtually nothing. You are paying for server compute time and bandwidth, which is a fraction of a cent per transaction. So as that 30% growing subscription revenue becomes a larger and larger slice of the total revenue pie, the overall gross margin of the entire company is mathematically pulled upward.
And the bottom line metrics reflect that efficiency beautifully. Operating income was $43 million. Net income was $38.8 million. Adjusted diluted earnings per share hit $1.79.
Strong numbers across the board.
But the number that I think cuts through all the accounting noise is their adjusted EBITDA. Earnings before interest, taxes, depreciation, and amortization. They hit $67.7 million in adjusted EBITDA, which is 21.2% of their total revenue.
And if you look closely at the cash flow statement, their free cash flow was practically identical at $68.1 million. The CFO, Dave Wood, made a point to highlight this alignment.
Because it's rare.
It is. When EBITDA and free cash flow move in lockstep like that, it signals incredibly high-quality earnings.
It means the profits aren't just an illusion created by aggressive accounting practices or massive depreciation schedules. It means they are actually generating cold, hard cash at a 21% margin.
Which gives them the balance sheet flexibility to reinvest in R&D or pursue strategic acquisitions without having to take on toxic debt.
Precisely. Which brings us to part 2 of our framework, the story behind the numbers. Because looking at these pristine metrics naturally pulls us into the broader narrative. It's one thing to see the gross margin expand on a spreadsheet,
Right.
But it's another entirely to understand the brutal multi-year gamble that made it happen. Massive revenue growth in a highly competitive sector like hospitality tech does not occur by accident.
No, it requires a structural, almost unfair competitive advantage.
And the CEO, Ramesh Srinivasan, was very candid about where that advantage came from. He talked about a future-proofing decision the company made years ago to rewrite their entire product ecosystem to be cloud native. Now, to an outsider, rewriting software might just sound like a standard IT upgrade. But in the enterprise software world, choosing to rewrite a massive legacy code base from scratch is generally viewed as, well, a suicidal undertaking.
It's literally the single most dangerous strategic decision a software CEO can make, which is why almost no one does it.
Let's look at the mechanics of why it's so difficult.
Okay, so a legacy PMS that has been running for 20 years is a monolithic block of code. Millions of lines, all intertwined. Every time a new feature was added over the decades, a developer just bolted it onto the side of the monolith.
Like a giant Jenga tower.
Exactly.
Yeah.
Over time, it becomes this fragile, unmanageable house of cards. If you try to update the reservation module, you might accidentally break the housekeeping module because the code dependencies are so tangled.
So the easy way out, which is the path most of their competitors took, is to just leave the old, fragile code running in the background and build a slick, modern-looking user interface on top of it.
Right, lipstick on a pig.
Yeah, it's like putting a digital touchscreen dashboard into a 1990s gas-guzzling car. The driver thinks they have a modern vehicle, but the engine underneath is still wildly inefficient and incapable of integrating with modern diagnostic tools.
That is a perfect technical analogy.
Ah.
The legacy competitors built web interfaces over their old monolithic code bases and tried to market them as cloud. But Agilysys took the brutal path. They threw away the old engine. They moved to a true microservices architecture.
Meaning what, exactly?
Instead of one massive block of code, a cloud-native architecture breaks every single function into a tiny, independent, containerized service.
Okay, so the reservation engine is its own self-contained module. The inventory tracker is its own module. The payment gateway is its own module.
Correct. And they all talk to each other via standardized APIs, application programming interfaces.
But building that from scratch takes years.
Yes. And during those years, your R&D budget explodes. You have to divert your best engineers away from building shiny new features that the sales team wants and force them to rebuild the invisible foundation.
Meanwhile, customers get frustrated because the product roadmap seems to stall.
Right. And Wall Street gets furious because operating margins compress. Honestly, many tech companies simply run out of cash or the CEO gets fired by their board before the rewrite is finished.
But Agilysys made it across the desert.
They did.
They finished the rewrite, and now we are seeing the payoff in these Q4 sales execution metrics. Because I want to read these off. They are staggering. In a single quarter, they added 20 brand new customers. And these weren't small mom-and-pop motels buying a single cash register.
No, these are enterprise clients.
Right. These 20 new customers purchased an average of 7 distinct products each. That is 140 individual software implementations just from net new logos.
Wow.
On top of that, they added 85 new properties from existing parent company clients, and they logged 129 instances of cross-selling into existing properties.
That cross-selling velocity right there, that is the direct, undeniable result of the microservices architecture we just discussed.
How so?
Well, when a competitor tries to cross-sell a new module, it requires a massive, painful integration project because their underlying code is tangled. But when Agilysys cross-sells a new module, it is practically plug and play.
It operates precisely like a modern smartphone ecosystem.
Exactly.
When you buy a smartphone, you aren't just buying a device to make calls. The hardware manufacturer knows that once you are in the ecosystem, the friction to buy their smartwatch drops to zero because it natively syncs with your phone's health app.
Right.
Then you buy their wireless headphones because they instantly pair. Then you subscribe to their cloud storage. You aren't trapped in a walled garden. You choose to stay because the unified architecture fundamentally reduces the friction of your daily life.
And Agilysys refers to this dynamic as their land and expand strategy. Your ecosystem analogy maps perfectly onto a mega resort.
Walk me through it.
Okay, imagine a massive casino in Macau. Agilysys might initially land the contract just to provide the point of sale software for the casino's 5 high-end restaurants. The resort implements it, and it works flawlessly. Then the resort's IT director realizes, wait, if we use the Agilysys Spa software, the spa reservation system will automatically talk to the restaurant POS via the unified API.
So a guest can finish a massage, walk straight into the steakhouse, and the host at the restaurant already knows their dietary preferences, their room number, and their VIP status because the data is flowing through the exact same central nervous system.
Exactly. Then they add the golf software, then the mobile check-in kiosks. Because the cloud-native data architecture is unified, adding the 5th or 6th Agilysys module delivers exponential value compared to buying a cheaper, isolated software solution from a third-party startup.
It creates incredibly high switching costs.
Massive switching costs. Once a resort is running 7 integrated Agilysys modules, the operational pain of ripping all of that out and moving to a competitor is so astronomically high that retention rates approach 100%.
That seamless data integration provides the perfect bridge to the most heavily scrutinized topic on the earnings call, and that is artificial intelligence.
Ah, yes, the buzzword of the year.
Every single software CEO is currently mandated to say the word AI at least 5 times on their earnings call just to appease the algorithmic trading bots.
It's so true.
It is incredibly easy to be cynical about this. The vast majority of these companies are just plugging a basic OpenAI wrapper into a chatbot and claiming they have revolutionized their industry. I want to know, is the AI strategy Agilysys is deploying actually driving operational value, or is it just buzzword bingo?
I mean, skepticism is entirely warranted here, but the transcript reveals that Agilysys is deploying highly specific mechanical AI integrations that solve actual operational bottlenecks.
Okay.
They aren't just slapping a chatbot on a website. They categorize their AI initiatives into 4 distinct pillars: agentic AI, multimodal interfaces, hyper-personalization, and intelligent revenue optimization.
Okay, let's strip away the corporate phrasing. What does a multimodal interface look like mechanically when deployed in the real world?
Multimodal simply means interacting with a computer system using human modalities like voice or natural language text, rather than forcing the human to learn the computer's language of mouse clicks and drop-down menus.
Okay, so talking to it.
Right. They have deployed AI-driven voice and chat ordering, specifically designed for their managed food service clients, utilizing platforms like Microsoft Teams and Amazon Alexa.
So how does that data actually route? Let's say I am a corporate employee sitting in my cubicle and the company cafeteria runs on an Agilysys POS. How does my message in Microsoft Teams turn into a physical sandwich on a tray?
Mechanically, it's a brilliant use of API routing. You type a natural language sentence into Microsoft Teams, order my usual turkey club, no mayo, I'll pick it up at 12.15.
Standard message.
The Microsoft Teams application sends that text string via an API call to the Agilysys natural language processor. The AI analyzes the text, identifies the user token, pulls up your past order history to verify what the usual mean. Yeah, and it translates no mayo into the specific POS modifier code for that kitchen and generates a structured JSON data payload.
So it takes the messy human language and instantly turns it into structured machine language.
Yes, it then injects that structured payload directly into the cafeteria's local kitchen display system. A ticket prints on the line or appears on a screen, perfectly formatted for the line cook.
To the employee, it felt like texting a friend.
Right, but to the kitchen, it looks like a standard digital order. By completely removing the friction of standing in a line or navigating a clunky ordering website, the cafeteria operators see a massive increase in order volume and throughput.
That is a tangible, measurable ROI. But what about the hotel side of the business? Management talked heavily about something called agentic AI and a digital twin for the front desk. How does an AI agent differ from a standard algorithm?
Well, a standard algorithm processes data and gives you an output, kind of like a calculator. An agent in AI terminology is a system that possesses a degree of autonomy.
Autonomy, like doing things on its own.
Yeah. It doesn't just answer a question. It takes multi-step actions across different software modules on behalf of a human user. The digital twin, Agilysys, acts as a co-pilot for the front desk worker.
Okay, walk me through a specific scenario. A VIP guest walks up to the front desk. What is the digital twin actually doing in the background?
Let's say the guest is checking in, but they also want to request a late checkout. They need extra pillows sent to the room, and they want to book a table at the sushi restaurant for 8 p.m.
Typical resort request.
In a legacy PMS system, the front desk agent would have to navigate through 4 completely different software screens. They click into the reservation module to adjust the checkout time. They open a separate task management window, type out a message, and route it to the housekeeping department for the pillows.
Right.
Then they tab over to a completely different web browser to log into the restaurant reservation system to book the table.
The human worker essentially becomes a data entry clerk, frantically typing and staring at a monitor while the VIP guest just stands there in silence.
Exactly. It destroys the hospitality experience. But with the agentic AI digital twin, the human worker simply types or speaks one natural language command into a single interface. Extend checkout to 2 p.m., route extra pillows to housekeeping, book sushi for 2 at 8 p.m.
One sentence.
One sentence. The AI agent parses the intent, autonomously queries the SQL database to adjust the checkout time, pings the housekeeping API to generate a task on a maid's tablet, and queries the restaurant POS database to lock in the table.
The cognitive load on the human worker drops to near zero.
It completely vanishes.
They can actually look the guest in the eye, offer them a glass of champagne, and provide genuine hospitality. The technology becomes invisible.
Which is the whole point.
That is a profound operational shift. But, let me challenge the competitive moat here. Large language models and AI agents are rapidly becoming commoditized. Startups are building sophisticated AI wrappers in their garages every weekend. What prevents a nimble, well-funded Silicon Valley startup from building a digital twin for hotels and just undercutting Agilysys on price?
It is the defining question of the AI era, and the CEO tackled it head-on. The foundational AI models, the neural networks parsing the text, are indeed commodities. You can rent access to them from OpenAI, Anthropic, or Google for pennies.
Right.
But an AI model is completely useless without domain-specific data to ground it. The algorithm is the engine, but the proprietary, highly structured data is the fuel. And Agilysys owns the oil reserves.
Because they have spent decades operating as the central system of record.
Exactly.
They possess the transaction logs, the behavioral patterns, the deep operational workflows of how a massive casino actually functions on a Tuesday night versus a Saturday holiday weekend.
Yes. And crucially, in the hospitality sector, that data is heavily guarded by regulatory compliance.
Yeah.
We were talking about personally identifiable information, or PII.
Oh, sure. Credit card numbers, passport data.
Home addresses, VIP travel patterns. A massive global hotel brand cannot and will not allow a random tech startup to dump their highly sensitive guest data into a public large language model to train a chatbot.
The security risks and compliance violations would be catastrophic.
So the moat isn't the AI itself. The moat is the secure, governed, cloud-native architecture that safely houses the proprietary data. Agilysys can deploy AI inside their secure perimeter, training the models exclusively on the hotel's siloed data without ever exposing it to the open internet.
A startup simply cannot replicate that trust or that integration layer overnight.
Furthermore, management revealed that this AI capability is creating an internal compounding effect. It is drastically shortening the sales cycles.
How so?
Enterprise CIOs are so desperate to deploy these AI efficiencies that they're accelerating their purchasing decisions. Simultaneously, Agilysys developers are using AI coding assistants to write and debug code faster. They are achieving higher R&D throughput without having to aggressively scale headcount.
It's a textbook flywheel. The AI makes the developers faster, which allows them to release new features quicker, which wins more enterprise contracts, which feeds more proprietary data into the system, which makes the AI even smarter.
A beautiful, virtuous cycle.
And that cycle provides the perfect transition into part 3, management guidance. Because the stock market is entirely a forward-looking mechanism, we need to dissect what management is promising to deliver in fiscal year 2027.
The baseline guidance is highly confident. They are projecting total revenue for FY27 to land between $365 million and $370 million.
Okay.
They explicitly reiterated that total subscription revenue growth will hit that critical 30% threshold once again. And they anticipate professional services, the consulting and implementation teams, to grow between 5 and 10%.
But hovering over all of these clean, predictable numbers is an absolute behemoth of a variable. We have to dedicate serious time to analyzing the Marriott deal.
Oh, yes. The elephant in the room.
For those who aren't familiar, Agilysys recently won an unprecedented contract to become the property management system provider for Marriott properties globally. This is arguably one of the most complex, high-stakes technology deployments in the history of the hospitality industry. How is management communicating the progress of this rollout?
Well, if you read the transcript closely, both the CEO and the CFO are employing a masterclass in expectation management. They're being incredibly, deliberately cautious.
Interesting.
The CEO stated clearly that the project is progressing well and that the Marriott team is executing brilliantly. But then he pivoted and issued a very specific warning to the Wall Street analysts dialing in. He said, "I would be careful not to expect perfect rollout cadence."
Wait, why would a CEO go out of his way to throw cold water on a massive historic win? Usually executives use these mega deals to pump up the stock price.
Because the CEO understands the brutal realities of enterprise software deployment, and he understands the asymmetric risks of Wall Street modeling. Replacing a legacy system across thousands of properties in dozens of countries is not like flipping a switch.
No, of course not.
You are dealing with properties running highly customized, decades-old code. You have to migrate massive, fragile databases of loyalty points. Now, think of the scale of the Marriott Bonvoy program alone. You have to physically retrain tens of thousands of front desk workers across different languages and cultural norms.
The logistics are mind-boggling. I mean, a hurricane could hit Florida and delay 50 property installations by a month.
Exactly. Or a new data privacy law in Europe could require a sudden pause to rewrite compliance protocols. The variance is infinite.
And Wall Street analysts hate variance.
They despise it. Analysts build perfectly linear spreadsheets. If they model out that Agilysys will install 100 properties a month, every single month, and then a totally normal operational speed bump occurs, causing them to only install 80 properties in Q3, Wall Street will declare it a disaster.
Agilysys will miss their quarterly earnings consensus, and the algorithmic trading bots will hammer the stock price, erasing billions in market cap over a completely normal logistical delay.
Right, so management is preemptively sandbagging the guidance. They are intentionally suppressing the near-term expectations. In fact, they'd explicitly stated that they are stripping the Marriott backlog out of their headline sales numbers to prevent the base business metrics from looking artificially inflated.
By modeling a highly conservative, bumpy rollout cadence into that $365 million revenue target, management is actually giving a profound gift to retail investors.
How so?
Well, they're aggressively de-risking the downside. If the Marriott rollout faces severe delays, the core business, the non-Marriott clients, is still growing fast enough to hit the 30% subscription growth targets. The floor is exceptionally strong.
That's a great point. And if the Marriott rollout hits a groove and the properties start deploying faster than the conservative timeline,
then it becomes pure, unadulterated upside surprise. It's a financial call option with almost zero premium attached. The baseline guidance is secure, and any acceleration in the mega deal falls directly to the bottom line as an earnings beat.
As an investor, you want to align yourself with a management team that builds a titanium floor under their projections while leaving the ceiling completely open.
Definitely. Now, the mechanics of how that revenue falls to the bottom line brings us to the profitability roadmap. The CFO outlined a margin journey for the upcoming year that requires some deep technical unspooling. He noted that in Q1 of the new fiscal year, their adjusted EBITDA margin is going to compress, dropping down to the 16 to 17% range.
Yeah.
But then he projects it will rapidly scale up to 24% for the full year, ultimately exiting Q4 at nearly a 30% run rate. Why does the margin collapse in Q1 before almost doubling by Q4?
The Q1 compression is driven by two highly predictable, heavily front-loaded expenses. First, the logistical staging for massive enterprise deployments, like Marriott, requires immense upfront capital.
You have to build the infrastructure first.
Exactly. You have to hire the integration specialists, spin up the cloud server architecture, and build the training modules months before the recurring subscription revenue actually begins flowing. The costs hit the P&L immediately. The revenue lags behind.
You have to build the factory before you can sell the cars. What's the second expense?
Well, Q1 is when Agilysys hosts Inspire, their massive global customer user conference. Renting out convention centers, flying in executives, and hosting thousands of clients is a massive, multi-million-dollar marketing and customer success expense that hits the ledger exclusively in the first quarter.
But it is a necessary expense to drive the cross-selling pipeline we discussed earlier.
Absolutely.
Okay, the Q1 dip is logical, but the climb back up to a 30% margin by the end of the year, that is a massive acceleration. To understand how a company practically doubles its profit margin in 9 months, we need to thoroughly explain the concept of operating leverage. It is the defining financial characteristic of a mature SaaS company.
Operating leverage is the mathematical phenomenon where revenue grows significantly faster than the underlying fixed costs required to generate that revenue. Imagine a set of jaws opening wider and wider.
Okay.
The top jaw is total revenue, expanding at 15 to 20%, driven by that highly profitable subscription bucket growing at 30%.
And the bottom jaw is the operating expenses, primarily research and development.
Precisely. And the CEO highlighted a critical inflection point regarding R&D. Remember the multi-year Valley of Death rewrite we talked about?
Yeah.
During those years, R&D spending as a percentage of revenue was massively inflated, sitting around 22%. They had to overhire engineers to build a new foundation. But now that the cloud-native architecture is fully built and deployed, that heavy lifting is done. The R&D requirement drops from structural engineering back down to standard feature maintenance and AI integration.
So management noted that R&D expenses, excluding share-based compensation, are dropping down into the high teens as a percentage of revenue. The fixed costs are stabilizing, or at least growing at a fraction of the rate of revenue.
And that stabilization is the spark that ignites operating leverage. Once a software company covers its fixed R&D and administrative base, every incremental dollar of new subscription revenue drops almost entirely straight to the bottom line.
It isn't eaten up by manufacturing costs or raw materials.
Exactly. The flow through to profit is massive. As Agilysys scales past $350 million in total revenue, the gap between the top jaw and the bottom jaw creates a geometric explosion in free cash flow, which gives management total confidence in hitting that 30% EBITDA exit velocity by Q4.
And to ensure that the top jaw, the revenue, keeps compounding, they are continuously launching new high-value modules. During that Inspire conference, they announced 2 major additions to their ecosystem: a new CRS, or central reservation system, and a highly anticipated revenue intelligence module.
Right, the analysts were very focused on these.
The Wall Street analysts on the call were peppering management with questions about these specific products.
And management was very disciplined in their response. They explicitly stated that these new modules are currently in beta testing with early adopters and will not move the financial needle in the current fiscal year. They are not modeling any significant revenue from them into the FY27 guidance.
Another brilliant example of sandbagging the near-term expectations while laying the groundwork for the long term.
Exactly. Strategically, these 2 modules are the massive engines designed to power the company's next phase of growth. They are the keys to unlocking the path from their current 300+ million size toward a 500 million run rate, and eventually the elusive 1 billion enterprise milestone.
Let's break down the mechanics of the revenue intelligence module, because the philosophy behind it fundamentally changes how a hotel operates. Traditionally, the gold standard metric in the hotel industry has always been RevPR, revenue per available room.
The classic metric.
It's a deeply ingrained, siloed way of thinking. The front desk's only goal is to maximize the nightly rate for the bed.
Right, because RevPR is a legacy metric born from legacy disconnected software.
Yeah.
The rooms department only had visibility into the room software. They had no idea what was happening in the restaurants or the casino floor. But because Agilysys provides the unified digital plumbing across the entire property, their revenue intelligence layer can optimize for a vastly superior metric: total revenue per guest.
This is where the data moat becomes an offensive weapon. Let's trace the data flow. A guest named Sarah calls to book a room. The legacy system looks at the date, sees that the hotel is 80% full, and quotes her a premium rate of $400 a night.
Okay.
Sarah thinks that's too expensive and hangs up. The hotel loses the booking. But if the hotel is running the Agilysys revenue intelligence module, what happens differently?
The AI instantly queries Sarah's historical profile across the entire database. It sees that the last time she stayed, she spent $600 at the steakhouse, $400 at the spa, and $1,000 at the blackjack tables.
Her value is not the bed she sleeps in.
No. Her value is the ancillary spending. The AI algorithms calculate her total revenue per guest projection and instantly alert the booking agent to offer Sarah a heavily discounted room rate, say $150 a night, or even a free upgrade.
So the software intentionally takes a loss on the room rate because it mathematically knows it will capture a massive margin on the dining and entertainment.
Exactly. A standard siloed room management system would never have the data visibility to make that calculated trade-off.
It shifts the property from fragmented departmental infighting to holistic, property-wide margin optimization. It elevates Agilysys from being a simple operational tool to being a strategic, revenue-generating partner for the hotel.
And when software demonstrably increases a client's bottom line, pricing power shifts entirely to the software vendor.
Which locks in those massive retention rates and justifies future price increases on the subscriptions.
Yep.
We have covered a truly massive amount of technical and financial ground today. We have dissected the compounding math of SaaS revenue, the brutal realities of cloud-native rewrites, the API routing of their AI deployments, and the psychological expectation management of their forward guidance.
It's a lot to take in.
It is. Now we arrive at the critical synthesis, part 4. We have to take a definitive, actionable stance for the retail investor listening to this breakdown.
The goal here is to distill all of this complexity into a clear, actionable thesis.
Based on the underlying mechanics of this earnings call, I think it is impossible to arrive at anything other than a highly, highly bullish outlook for Agilysys. The structural fundamentals are not just strong, they are accelerating in a compounding fashion.
I agree. The bullish thesis rests entirely on what the CEO defined as the virtuous double benefit combination. You have two massive forces working in tandem.
What's the first force?
First, you have record-breaking new sales execution. Adding 20 new customers in a quarter, averaging 7 products each, proves that their sales team is ruthlessly effective at capturing new market share, and that the market desperately wants their modernized architecture.
And the second force is the retention rate. The CEO described their retention as better than world-class. In the SaaS industry, a high growth rate is utterly meaningless if you suffer from the leaky bucket problem. If you pour 100 new customers into the top of the funnel, but 80 frustrated customers cancel their contracts and leak out the bottom because the software is buggy or fails to integrate, your net growth stalls out. Agilysys has functionally sealed the bottom of the bucket.
The modernized microservices architecture works flawlessly. It is stable, it integrates seamlessly, and customers simply do not leave.
They have transitioned from being a passive database, a digital filing cabinet, into what management beautifully termed an intelligent system of action.
I love that phrase.
They are not just passively storing the guests' credit card data anymore. Their AI layers are actively intervening to optimize the hotel's revenue, automate the kitchen's routing, and remove the cognitive load from the front desk staff. They have become the indispensable brain of the modern hospitality enterprise.
So if you are a retail investor who already holds a position in this stock, or if you are meticulously researching an entry point, what are the specific actionable metrics you need to track over the next 4 quarters?
Right.
You don't want to just look at the stock price. We want to look at the gears turning the machine.
Your first priority is to relentlessly track the gross margin trajectory. Management has clearly mapped out a target of hitting the mid to high 60% range by the end of the fiscal year. You need to verify that this is actually happening.
Right. Every quarter, check the product mix. If the flat hardware sales remain flat and the 12% subscription growth remains steady, that gross margin must mathematically expand.
And if it doesn't?
If the margin stalls or compresses unexpectedly, that is a massive red flag indicating either severe pricing pressure from competitors or escalating server costs that are eating into profitability.
Good point. And the second actionable item is to monitor their commentary around organic market share. The Marriott deal is incredibly flashy, but we cannot lose sight of the broader total addressable market.
This is perhaps the most crucial point for long-term investors to grasp. Management explicitly stated that their current market penetration in both the managed food services vertical and the core hotel and resorts vertical is still remarkably low.
They are in the very early innings of a massive global cycle of cloud adoption.
Exactly. So they do not require another historic, headline-grabbing mega deal to hit their 20% total revenue growth targets. The runway for organic, predictable growth, just by showing up to regional hotel chains, proving that their unified platform is better than the fragmented legacy systems, and systematically stealing market share, is vast.
A massive total addressable market, a demonstrably superior and modernized product, pristine retention rates, and structurally expanding margins. It is the exact blueprint you look for in an enterprise software investment. Couldn't agree more. That brings our analysis full circle. I want to sincerely thank you, the listener, for committing the time to take this deeply technical Wall Street-style journey with us. Navigating an earnings call is never easy, but by looking past the superficial headlines, ignoring the noise, and understanding the precise mechanics of cloud architecture and operating leverage, you equip yourself with the tools to make fundamentally superior investment decisions.
The power in investing doesn't come from reading the numbers. It comes from understanding the physical and digital realities that force those numbers to move.
Exactly. Before we sign off, we always like to leave you with one final provocative concept to analyze on your own. We try to take the core mechanics of what we've discussed today and project them into a future scenario that wasn't explicitly covered in the earnings call, but exists as a very real possibility.
Consider the core competency that Agilysys has perfected. They have built an incredibly secure, AI-powered, cloud-native ecosystem specifically designed to optimize total revenue per guest across vastly complex multi-departmental physical spaces. They know how to integrate a bedroom, a restaurant, a retail shop, and a recreation center into a single unified data stream.
A mega resort is basically a small, highly complex city.
Precisely. Now, zoom out from the hospitality industry. Think about other massive, real estate-intensive sectors that operate with almost identical logistical complexity, but are currently suffocating under decades-old fragmented software.
Like what?
Think about a massive state university campus.
Yeah.
You have tens of thousands of students who need housing assignments, dining hall meal plans, access to recreation centers, and retail purchases at the campus bookstore.
Wow, the logistics of a university are functionally identical to a casino resort, just without the blackjack tables.
Or consider a sprawling multi-campus hospital network. You have patient room inventory to manage, massive cafeteria and managed food service operations for staff and visitors, specialized treatment scheduling, and highly secure, IPA-compliant personal data flows.
Oh, that is a profound thought. If the Agilysys architecture is this demonstrably successful and this secure at managing the intricate financial and operational logistics of a global hotel brand, the technology itself is agnostic. It doesn't know it's running a hotel. It just knows how to optimize space, inventory, and human interaction.
Could this intelligent system of action eventually be adapted, repackaged, or licensed to become the foundational operating system for universities, hospitals, or massive corporate campuses? The total addressable market in hospitality is already enormous. But if this architecture successfully bridges into adjacent, multi-billion-dollar real estate sectors over the next decade, the scale of this company could radically transform.
It is a massive structural question to keep in the back of your mind as you watch their AI platform mature.
A brilliant thesis to leave you with. Keep an eye on those gross margins and watch how that digital twin evolves.
Thank you for joining us on this deep dive. We'll be back next time to filter the noise and find the signal.